When you're looking to sell your startup, the key metrics beyond the tech itself or the product and those aspects, the key metrics that any buyer is looking at is they're looking at what are your growth rates and what is your profitability. And they're looking at those because, hey, those are the two levers that matter in the long term for any business. How much larger can the revenue get? And then what percentage of that is profits that come into my pocket as an investor? So a simple way to look at it from both a strategic and a financial buyer perspective is that what's sort of a minimum growth rate, minimum profitability? There's a rule that VCs use called the rule of 40. And the rule of 40 is that these two numbers added together should be greater than 40. So take your growth rate in revenue terms, and let's say that you grew 30% last year. Well, then if you had a profitability, like a percentage, and here they typically mean EBITDA percentage, so essentially pre-tax earnings for simple companies. If that's 10% and that's 30%, well, then you've gotten to that 40 minimum threshold. I will note that this is a minimum. So the higher you can get this, the better. If you can get to 50% growth and 20% profits, that's going to help raise your valuation further. So however high you can get this. But if you fall below, it's worth noting, what's the lower bound to even be considered? So both PE and VC folks internally, whether or not they tell you this, they have a 20% is considered the minimum threshold for a rate of return on any investment that they're going to really consider seriously. And a lot of financial buyers, a lot of times, are private equity firms. So that 20% minimum means that it's very hard for them to buy a company if it's not growing faster than 20% per year. Because the easiest way for them to make their money is they buy it for X today. If it's growing at 25% per year from there, well, as long as they can keep that trend up and they have confidence in that, then they can get the rate of return that they need. Remember, one of the key things that they're going to look to do after buying is to optimize the business. They are better at raising profitability in general than they are at raising growth. So that's why they'll look at growth and want to check and see okay, does this product or does this company, does it have the growth rate needed to justify us buying it or not? So if you're down at 0, 5, 10% growth, well, you're probably just not high enough to get a meaningful valuation. There is a buyer for all companies at some price, but that's not going to be a price that you're likely going to want to sell the company for. I mean, to use a concrete example, let's say that you are extreme case, a 0% growth company, just sort of or growth rate of equals inflation, a couple percent a year. But let's say that you are profitable. Well, at that point, all they're doing is they're buying that cash flow. There's no growth. They're just buying the cash that's coming out of the company. So they may, depending on other variables and factors, they may only be willing to pay a low or mid-single digit multiple of that cash flow. It really has a lot to do with how long-term the cash flow is. So the other dynamic that they'll look at there is what they call earnings quality. So, and this is actually something that every deal, you end up getting a bunch of accountants coming in during due diligence, checking your earnings quality to see how long-term are your contracts and, what's the probability of customers rolling off and what does churn look like, all of those kinds of things. But earnings quality is one of the things that, will help them assess the quality of your profitability. At the end of the day, though, the variable that they're looking at hardest is growth. They will buy a 70, 80% growth company with negative profitability. They may not buy a 5% growth company with positive profitability. So something to keep in mind, value growth over profitability. But if I say that, you've probably heard me talk about profitability a lot and why it's so important. So if your M&A valuation, the primary lever is growth and for profitability is the second lever, why do I talk about profitability so much? Because, and this is a different reason, profit equals control. Control your destiny. That's really why it's important to be profitable. If you are profitable, then you can choose whether or not to sell and when to sell. And of course, the timing matters a lot in terms of valuation as well. So profitability gives you control, which is crucial, over the long term as well. You can walk away from a bad deal. So it does give you a valuable lever at the negotiating table, although growth is still the primary driver.